Hello, everybody. This is Ilya Spivak, head of global macro here at tastylive. Welcome. If you're in the U.S., I hope you had a restful President's Day holiday. We are going to jump right back on this difficult first day for markets. Stocks lower, yields higher. Everybody's speculating that we're going to have a bit more difficulty ahead relative to Fed policy expectations. We're going to jump right back on that narrative, obviously something we've been talking about for quite a long time here on Macro Money, and talk about what will be the first piece of critical event risk for this story this week, which is minutes from the February FOMC meeting. Now, I'm going to take a little bit of a look as to why this is so important, why this is the critical narrative shaping markets. We talked about it last week. We'll just remind ourselves to make sure that we're all on the same page, then talk about some of the inputs into what might be going on and why this shift in Fed thinking, at least as far as the markets are concerned, is perhaps occurring, and then also get some sense for what these minutes might actually do, where they might move markets, how they might do that, and so forth. So let's jump right in here and initially get some perspective on why all of this is important. So what you see in front of you in the orange is the 12-month forward rate implied in Fed funds futures for the Fed policy rate. Obviously, the Fed sets policy in ranges, and this is a single number, so consider this a kind of median. But what this essentially tells you is where Fed policy is expected to be 1 year forward from any given moment in time. What the kind of dark line there is telling you is the level of credit stress in financial markets. That's the financial stress index from the OFR, the Office of Financial Research, which is an entity within the U.S. government. What you see there is as Fed rate hike expectations started to build from about the middle of 2021, and as those rate hikes here, level of financial stress in the system was, of course, rising. This makes sense. You're seeing higher borrowing costs start to be applied, and an understandable concern that there's businesses and loans and investments and other capital allocations that after 13, 15 years of rock bottom rates aren't going to work if you have a higher sort of hurdle rate on borrowing. And if that's the case and those things fail, you might have credit stress in the economy because you would have those entities that fail unable to pay their debts, write those debts down, but of course one person's debts or one entity's debts is another person or entity's income. And so on the other side, the lenders that offered capital to whatever might fail here, that of course has to take a write down as well, raise cash, perhaps sell good quality assets in order to do that. And so as we've had rising borrowing costs, so too the level of credit stress and the possibility that that conditions might get worrying, that index going higher. You can see that much of the rally in risk assets that then followed from about, let's call it middle November, middle October, early November, you have a pause in the build out of forward Fed rate hike expectations. And so the credit risk gauge comes quickly lower on this idea that perhaps the Fed is done and perhaps the end of where they're going is already visible and baked into markets. That's that long pause in the orange line. But of course now, as you can see, not only has it started to go higher again, it is beginning to get to levels it hadn't seen before. So it's actually overcome the prior highs from last year. You can also see that against that backdrop, the credit stress index has stopped falling. which isn't necessarily a precursor to it going back up, but certainly is more of one than it sinking like a rock. You can see why this is important. The fall in credit stress has been something that's occurred in almost perfect inverse to the rise in U.S. shares. You can see the red line there, the S&P 500 future, and that is something that's been rallying, as we can see here, from late last year, and moving in almost exact inverse of that credit stress indicator, which again makes sense. If you do not have a rise in credit stress, you do not need to sell off risky assets to raise cash. Well, that's good news for allocating to risky assets like equities. Risky, of course, in relative terms to, let's say, bonds or cash. What you see now, and indeed on a day like today, this is in very stark relief, as that credit gauge has stopped falling, stocks have started to shred downward. And so that's the underlying reason why we care about all of this, why the markets are so focused on all of this, because what we're talking about is the underlying cost of money. This is something that supersedes sector performance versus unperformance, company-specific relative performance, even geographic relativity in performance. So let's say U.S. shares versus those in China versus those in Europe. All of those things are superseded by, is money to invest or to offer capital to some sort of speculative or growth venture, is that capital even available? Does it even make sense to be allocating capital to those kinds of ventures? Well, that's a function of how much that capital costs and how expensive it would be to replace that capital were one of those bets to go sour. So this is a story that exists above considerations of, will commodities of this stripe or that do well? Will this or that sector in the equity space do well or not? This is a much bigger story and affects, understandably then, absolutely everything and every corner, not just of the financial universe, but of the global economy, from the household all the way out to large financial institutions, corporates, and even governments. And so what we've seen, the sort of crux of the consternation, is this shift in the yield curve so far this month. And I've taken as the look back the last day of January and then looked at essentially where the yield curve has moved in relative terms. This is, of course, the immediately short end of the yield curve, which captures Fed funds rates, the currently implied ones in the market. And you can see that over the course of February, what you've seen is a significant steepening. So a very, very pointed shift higher in this curve. The peak still 6 months out from today, which lands us in August. Now, there is no Fed policy meeting in August, but there's one in July and there's one in September. So the peak seems to be somewhere in between there. What you do have in August, incidentally, mark your calendars now, is the Jackson Hole Symposium, which is where all of the Fed officials gather in Jackson Hole, Wyoming, have a powwow, and usually what will happen is the Fed chair, in this case Jay Powell, will give a steering speech where that will set the lens for how the Fed will think about policy for the next year. Last year famously took on a hawkish tone and ended a summer rally in shares where the Fed came out, signaled it was aggressively more hawkish than the markets thought, and that was another bout of risk aversion that we saw. We could very well see something like that here, but we have this sort of rough timing that August is where the peak will be set in. That peak is now much higher than it was. less than a month ago, you can see by the end of January, that peak was somewhere in the 475 to 500 basis points, or 4.75 to 5% range. We can see now we are well north of that. Now the range looking like we're somewhere in the 5.25, 5.5 range for the Fed. The Fed sets its policy rate in a range. There's an upper bound and lower. And so it looks like we're going to land here somewhere in that 525 to 500 to 550 basis point space, and then stay above 5% into next year. You can see we're still north of that 5% level as of the beginning of next year. So 1 year out would be mid to late February 2024. Now, you can see here a very clear look at what this looks like. So the peak now, there's the curve for September. It's in the orange. There's the curve for July. It's in the darker sort of grayish, bluish there. Call that what you like. It's there that the peak seems to be occurring. And you can see it's right in the middle of that 525 to 550 range. So somewhere in there, we've had a significant upshift. You can see through February, those areas were both sub 5%. So it looks like we've added at least one, probably two rate hikes into that space. So this, of course, has been the crux of the anti-risk shift in markets. Now, where is this shift coming from? Why did the market suddenly rethink this? Well, one big element in this story was, of course, the latest jobs report. You can see there's the green line there. We had a much better than expected 517,000 increase in non-farm payrolls. We also had a jobless rate that was at this stage about as low as it's been, 3.4%. It's tough to say that it's the forever record low, because records only are relevant to a point, but certainly the lowest that we've seen in decades. And that is something that ostensibly is telling the Fed the economy is still reasonably warm. There's still reason to keep the tightening regime there in order to make sure that we don't have inflation that gets entrenched. And of course, the vehicle for doing that would be wages. The concern for sticky inflation, at least from a domestic perspective, and there's external factors there as well. For example, deglobalization, the rupturing of supply chains, is something that makes the cost of doing business more expensive and is inflationary. And of course, the legacy of the trade war between the U.S. and China started in 2018 largely is still there. So the labor market is not the only factor, but if we look domestically in the U.S., the biggest worry about sticky inflation is wages. So you get into a situation where wages are high. That makes the cost of doing business more expensive. That makes companies raise the sticker on final goods, so things on the shelf actually become more expensive. Workers faced with that cost structure then go to their employer and say, well, I want higher wages. My cost of living is higher. And that, of course, becomes a self-reinforcing inflationary cycle. On and on, it feeds onto itself. That's not something that the Fed wants to allow to occur. And indeed, that's been their main concern as far as domestic dynamics are going. One critical aspect, and we've talked about this in detail in other sessions of Macro Money. Perhaps we'll revisit it here shortly for an update. One major reason to be a bit skeptical about this low unemployment rate and think that this is necessarily a sign that things are sustainable even as the Fed tightens and that inflation can come down without this really moving around is the participation rate in the U.S. economy has never really recovered from COVID because the members of the largest contingent in the labor force, the 55 and over, the baby boomers, accelerated the process of retirement. They've been exiting the labor force at a trickle years before COVID, and that retirement has given us a modest uplift in wages, in the pace of average hourly earnings growth, because the largest contingent of the labor force was exiting, and so shortages were somewhat more likely. But of course, we still had a labor market, and the pace was slow. What we saw in COVID is a rapid acceleration, as a lot of folks seemingly said, well, I was going to go and retire in a year or two. Everything is locked down. I might as well just go now. And so we now have a very low level of labor force participation, which if these people are not looking for work, if they're retired, well, then that they don't get counted in the unemployment rate. To be counted as unemployed, you need to not just not have a job, you need to also be looking for one. And if you're not counted. So it could be that this unemployment rate is actually not as rosy as it feels. Nevertheless, it is inflationary, because what we're talking about is a situation where labor shortages bid up wages. And of course, we still see a tremendous amount of job openings out there, even as we get a pickup like this 517K in payrolls. So the upshot is the labor market is still saying very inflationary things. If we look at the latest set of Purchasing Manager Index data, that's something that we saw released just earlier today, and that gave the markets a still further nudge lower. We see a bit of a pickup in business activity. So in the logic of PMIs, as we discuss here on Macro Money quite a bit, 50 is the magic number. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go under 50, the faster the contraction. And what you see here is that both manufacturing and services PMI has been improving. That's given us a better composite reading here. And what you see is the composite number, which is the one in the dark there, 50.2, that one is back above 50. Services, that's the one in the orange, back above 50. So the biggest sectors of the U.S. economy, services, of course, close to 75% here of the overall U.S. economy, it's not growing quickly, but at the very least, it's not shrinking for the first time since the middle of last year. Manufacturing is still on the side of 50 that points to contraction, but less so. The pace seems to be easing. And the overall number, because it is heavily skewed to services, is out of contractionary territory as well. So the economy is ostensibly no longer contracting, and that is and there is no longer that disinflationary force there. It is perhaps not immediately rallying and immediately accelerating at a brisk speed. But this is certainly not something that immediately screams at the Fed, you need to stop. Similarly, consumer confidence has improved since July. We can see that there's been a decidedly downward trajectory there, both for forward-looking expectations and the current conditions index, which gives us a net of that red line there, which is overall sentiment. Household consumption, again, nearly 3/4 of U.S. GDP growth. And if you put the last thing I just said together with that, you get that much of what the U.S. economy is powered by is household consumption services. You see here that very critical component, the key element keeping the U.S. economy moving forward, it's improving. Consumers have been feeling a little bit better. It's still not gangbusters. It's still not as strong as it was a year and a half ago. Nevertheless, better. And so again, not something that immediately screams at the Fed, you need to stop. Now, looking at the inflation story, we can look at the baked-in expectations for near-term inflation implied in the bond market. That's those yellow bars there. And you can see that in recent months, and especially in February, it's clearly not heading in the direction that the Fed wants. So you can see that as the Fed began to tighten, those expectations started to come in. And if we lag baseline inflation measures, here we have both CPI and the personal consumption expenditure index, the PCE index, which is the Fed's favored inflation gauge. If we lag them just 2 months to expectations, we can see as expectations come down, they anticipate a turn in overall inflation by that 2 months or so. And if we look forward, we can see over recent months, those expectations have stabilized. And in February, they've absolutely surged. So now we're looking at nearly 3% on that rate, which means that we might expect CPI numbers and the PCE gauge to start to level out here in the coming months. Again, telling the Fed, your work's not done here. You have to keep going. Something similar, of course, is what we've heard from Jay Powell in his most recent comments, saying this is a fight with inflation that's in the early stages. We may not even be near the middle, never mind the end. And so this then is what we're left with as baseline expectations. We can see we have fully baked in a hike in March. We have fully baked in a hike in May. And so you can see here that percent hike or cut column now has 100% and more of a 25 basis point hike. You can see that that's the magnitude in the last ARM column, average rate move. So 100% of a 25 basis point hike baked in. You can see the implied rate delta there, almost 30 basis points. So there's actually a narrow chance, 18% or so, that we might get a 50 basis point hike, still very low. So not anything that's commanding, but of course, these FOMC minutes that we might get here over the next, well, will get, but what they might contain over these next 24 hours here is a sense that maybe such a move is more likely. We've heard, for example, from Jim Bullard and Loretta Mester, both regional Fed presidents here over the past several days, that they considered a 50 basis point hike at the February meeting to have been the appropriate step. They ultimately backed off and voted with the majority for 25, but it may be that they were not alone. It may be that that contingent was greater, which if that were to show up in the minutes, that would give us a still more hawkish sense of where the Fed is and where it's going. So what you have now then is, at this point, at least 50 basis points more baked in. You could see 55 there for the implied rate delta by May. You also see that we actually might have 3 because you have 78 basis points fully baked in by July. From there, it seems like we top. And so it appears like we might give away, let's say, 25 or 50 basis points. Looks like whether it's 50 or less is right on the line there. You can see come January, we are 44 basis points higher than we are right now, which would imply that we've had a net 25 to 50, but closer to 50 basis point rise from now and until then, which would imply, on the way that this is set up, 75 basis points this year, and perhaps 125 basis point give back cut somewhere in December, perhaps, or January. That's where we are. If it seems like even that is a bridge too far, and it seems like we're going to hold with 75 basis points in hikes well into next year, that would be a more hawkish perspective. And if the minutes leave us with that sort of sense, then we end up with more risk aversion likely, lower shares, probably a stronger dollar, probably higher yields, probably weakness in the weaker elements of the asset universe. So certainly crypto, certainly higher beta currencies like the Australian dollar or the Canadian dollar, especially as relative to anti-risk alternatives like the yen, like the euro, certainly the dollar, which stands to gain broadly speaking. Probably weakness in gold, because higher rates make an asset that yields nothing progressively less attractive. And even within the equity space, a kind of risk-off dynamic where, like we saw earlier today, things like the NASDAQ, things like the Russell underperform more traditional cash-rich blue chip names in the Dow. Needless to say, if the minutes appear as though they are cooling some of this recent angst, well, then you might get a move the other way. And so we'll see if that fundamentally alters the perspective here. But the risk certainly seems to be that the market is amidst a more hawkish rethinking. And so that's the lens through which it will read these minutes. And recent Fed commentary suggests the Fed is not looking to calm markets with a more dovish tilt. It seemingly is looking to go the other way entirely. And so the risk seems to be asymmetrically on the defensive side of things, where that is the path of less resistance as opposed to the other way around. And that is macro money for today. Thank you very much for joining me. Once again, this is Ilya Spivak, head of global macro here at tastylive. We do this show Monday through Thursday every week. This Monday, obviously, we were off for the holiday, but generally Monday through Thursday every week, right after overtime, with our friend Christopher Vecchio, head of futures and Forex here at tastylive. Outside of show hours, feel free to follow my various ideas and musings about markets via Twitter at Ilya Spivak. Thank you very much for joining, folks. See you tomorrow. Godspeed.